Yep, coming through good. All right.
Man, what a day. Ooh, ooh.
Yeah, I know. It's a crazy bounce in the semiconductors.
I was thinking about buying some last night. I chickened myself out, although I think it might fade.
Yeah, I don't know how long this lasts.
And I was joking that with my friend that the market has to kind of round trip to punish all the people who got liquidated, because that's like, think about the worst thing that could happen would be a rat like the hated rally that punishes all the people that are exited.
Oh, yeah.
And I just think that the market finds ways to extract max pain, and so I was like, oh, maybe it's not a bad thing to buy, but everyone's reading the news on situational awareness and they think it's like, oh, well, the selling's done. Um, so they're trying to buy it now, but I don't know. I feel like this could fade. I don't really want to put more exposure on.
Yeah, no, I'm probably gonna use
I'm
this
gonna
to
get
exit
traded.
some things I should have exited earlier.
It might not be a bad opportunity. Yeah. Man, this Clarity Act stuff.
Yeah, they're running it right down to the wire.
I actually don't know procedurally how they get it done now. I think that's my biggest confusion is I just have no idea.
Yeah. I mean, I think they could probably still hold the Senate vote, but yeah, I don't know how they get the rest of that done in time.
No, the Senate, the problem with the Senate vote is you need 4 votes. And each vote, carries like a day between each the next one. And so it's just like I don't know how they, if you strictly believe in this like August 7th timeline, then I don't know how you fill the calendar and make it happen. Um, but maybe they suspend the recess for a bit. I'm not sure. It just feels like they'll have to do something like quote unquote unorthodox to make it happen
Yeah.
from a logistical or procedural standpoint. Guess we'll see.
Yeah. Yeah, the last time they suspended the August recess was 2018. It's very infrequent that they do it.
Yeah, that's the trouble. I think they're gonna have to do it though, one way or another. At least have the first procedural vote because they need to put people on the record um, for which way they voted. But I don't know what the calculus right now is live on the timing. It's very frustrating.
Hey, everybody.
Hey, how's it going?
Going pretty well.
We were just talking about the Clarity Act logistics.
Yeah. Yep. We will touch on that. It's not looking too great now, is it?
I
We're
actually
down.
haven't read like a credible um, you know, quote unquote like revision to the logistical path that gets you there before the recess. Yeah. I just don't know at this point.
Yeah, I mean, it's fair to say it's probably less probable for it to get on the floor before the recess. I think it's really just a moonshot right now for that. So we have to just probably push to September, right?
I don't know. I think the biggest like political question becomes, if you don't put it on the floor, then you don't have people on the record for how they were going to vote for this. And given the campaigns are going to start kicking off soon, this was viewed as kind of like a point of leverage or a wedge where you're now forced to be on the record, and you're going to be fundraising. And what does that mean for, certain PAC groups and whatnot that are looking at your record to determine whether they want to back you or not?
Yeah, I see it as like you have this political calculation of whether or not you're confident you have the votes right now. And if they do have that confidence, which I don't think they do, they could try and squeeze it in on August like 3rd or 4th, maybe just after the maybe just after all the other geopolitical bills or the geopolitical bill that's coming through. But like, if it goes to the floor and they don't have the votes, that looks, I think, more damning than not bring it to the floor at all, right? If you get, yeah. So that's what's going to be interesting to see. I guess we're just in crunch time, really, is what this is. And then we're going to have a little bit of a break, and then we'll pick it back up again.
Yeah, this one's disappointing.
Super disappointing. Okay, let's give it a couple more minutes. I think Tyler should be joining us, and then we'll kick off the show. All right, I see Tyler's joined. Let's see if we can get a sound check from you, Tyler, and test if the mic's working.
He doesn't have speaker privileges.
It does on mine.
Now he does.
There we go.
Perfect. Tyler, if you want to give us a quick sound check, 212, and we can just double check, make sure things are working.
Hey, good morning, guys. Can you hear me?
Yeah, sounds great.
Yep.
Awesome.
Perfect. All right. Well, I think we can go ahead and start kicking things off. We've got a lot to cover, so let me go ahead and do the introduction, and we can jump into our discussion. So good morning, and welcome back, everybody, for another CFB Talks Digital Assets Live. My name is Gabe Selby. I'm the head of research at CF Benchmarks. I'm going to be your host today. With me, as always, we have Mark Pilipczuk and Tomas Perfumo. And yeah, what a week we have for this next hour to talk about. In the past 24 hours, the Fed held rates steady, but we've seen some disagreements amongst the team there. We had 3 dissents. Meanwhile, long-term yields are climbing to levels I've seen since 2007. Washington's seems to be focusing on other things and pushing beyond what the crypto market structure bill, and it's leading us to a little bit of like a crunch time dynamic. That's what we were talking a little bit about before we kick things off informally. And we're seeing continued divergence here in the AI story with reported earnings coming out. With one company up now, I think over 10%, and the other down over 9%. So we'll go into kind of what our take is there. Before we kind of kick things off, I just want to bring Tyler in, give him a chance to introduce himself. Let us hear a little bit about your background, your story, and also give us a quick introduction on UTXO.
Great. Good morning, gents, and thanks for having me. I'm looking forward to this discussion. A lot going on in the markets for us to talk about here today, Bitcoin and beyond. But yeah, quick background on me. I'm the Chief Investment Officer at UTXO Management, and now also at Nakamoto Inc., the public company that acquired UTXO earlier this year. You know, I'm a career Bitcoiner. Got into Bitcoin and fell down the proverbial rabbit hole when I was doing my undergrad, and started BTC Media right out of college, which runs Bitcoin Magazine and the Bitcoin Conference series all around the world. So spent over a decade kind of building that business in Bitcoin media, education, and research. And then we launched UTXO, kind of our sister asset management firm, about 7 years ago, where we really focus on finding and identifying asymmetric opportunities within Bitcoin, and managing a couple private funds that give investors exposure to what we think is the frontier of Bitcoin, with some active management along the way. So glad to be joining you all today.
And looking at your website, is that where we can find some of your research and follow along with some of the stuff that you guys put out?
Yeah, our website, or our X handle, UTXO Management, is best place to follow us. We do publish some research from time to time and some market commentaries. So stay tuned for more views from our team.
Perfect. Okay, so well, yeah, like you were alluding to at the top of your response there, we do have a lot to cover, and I want to kick things off with the Fed, of course. I think it'd be fun to go around the horn like we did the last time we followed the Kevin Warsh's first press conferences. Now he's got his second press conference under the belt. Let's go around the horn and give him a grade for how he did. I know I'm gonna get a good response here from Tomas, so I want to start with you, if you don't mind. Giving us a definitive value here for Kevin on
I'm
round
gonna
two.
say I'm definitely gonna be more critical this round than the last. I'm gonna say a B minus on this one. And on the positive side, I think he's kind of sticking to his guns around the idea of not providing any kind of forward guidance, and I think he's delivering on that. Someone had done like a quick measure of just the vast majority of questions that the press are throwing at him are more related to forward guidance. And so that's where I think people felt perhaps disappointed, is that it felt like a ho-hum press conference where nothing was really said. But it was probably the direct result of the questions he was getting asked. But on the flip side, I do think that you can have a press conference where you're not offering like a forward guidance, while still providing kind of informative factual information about the meeting itself, or about the recent data prints and like key highlights from those. I think his choice to be like extraordinarily close guarded around it made it seem like he just didn't have anything at all to say. And perhaps what was most frustrating from the market standpoint is he basically told everyone, look, the market's tightening for us, so we don't have to do anything, which I think is actually true. And it's just going to require a pretty big shift in how the market just like thinks about Federal Reserve policy at this time. So yeah, I would say B minus on that front.
That's that is, I think, a nice downgrade from an A, I think is what you gave last time. You correct me if I'm wrong, but seems like we are adjusting the grading curve now that he's getting more experience. Tyler, what about you? What's your grade after yesterday?
Yeah, good feedback, Thomas. I largely agree with your sentiment. Full disclosure, I actually haven't watched the full presser, but I've been reading a lot of the reactions, commentary, and obviously watching the markets here. He is really trying. He inherited a tough job at a tough time, and I think this is him still trying to find his footing a little bit as Fed chairman. With his new mentality of really not giving forward guidance and having the Fed take a more backseat role that's almost more reactionary rather than proactive. And so I think he's happy to let the market do the work for him. And we saw, the 30-year yields rise significantly in the late afternoon after the presser. The market kind of tightening for him. But I think the market still really is trying to figure out how to respond to this dynamic where we don't have that kind of clear forward guidance, and where he was very, very tight-lipped, as you mentioned, Thomas, about being willing to comment on all of that, which is super interesting, kind of especially in the build-up to this meeting with the market consensus around what the Fed was going to do here, more divided than we've seen in a long time, and notably with the three dissents on the Fed decision.
Those are really good points. Mark, what about you? I think you also gave him an A last time.
Yeah,
Are you gonna
I gave him a
adjust?
B last time. We're going to take him down
Okay.
to a C. That was I think a pretty average performance. My read on the whole situation is they're trying to get a clearer look at the inflation picture. Really, you have three shocks going on. You have the oil shock hitting the headline, and then you have energy feeding through to some of the other components in PCE. You have the tariffs that are still kind of making their way off from last year. And then you have the whole memory shortage that really started in Q4 of last year, Q1, that really won't make its way through until the end of this year, beginning of next. So the base cases, they probably just hold for the rest of the year while they look at that. And they also, they have all the task force they said they were going to establish. That's still ongoing. So they're going to take a look at all their data. So yeah, it's just kind of an average, no forward guidance. The guy is, going to let the market handle the tightening on the long end. I know he's also been a balance sheet hawk in the past. Not sure if they're ever going to. I doubt they could really do much with the balance sheet, though, with how much the market's tightened. So they're really just kind of going to wait and see for a while, I think.
You guys remember what grade I gave him? Was it a C last time?
Yeah, it was.
It's probably, yeah. I mean, I thought he did an average job last time. I think right now he's definitely trending in the wrong direction. I'm gonna have to go with a D. Look, I think he's finding out in real time how under a microscope the Fed position is from like the perspective of what he says is going to be noted and then critiqued very heavily. And I think that's kind of an obvious thing that you should know when you take a job like the chairmanship of the Federal Reserve. And if you look at the comments that he made earlier this month when they were at a central bank conference in Sintra, Portugal, which by the way is a fantastic place. It's like a land out of fairy tale. If you haven't been, I suggest you guys go check it out. He was saying how he was totally fine with bond yields going down. He was in the view that this is a good for the markets, good for the economy, and he likes to see the financial conditions kind of loosen on themselves. Now he's talking about how he wants to see how the natural market tightening of higher yields kind of plays out. So I think the reporters, all the financial media is pretty astute to quickly point out the contradictions there, and like Tyler was saying, I mean, look, you're getting a 3 point, or I'm sorry, a 5.2 plus on the 30-year, which is bringing us back to I think 2007 levels, and obviously I think from a rate volatility perspective, structurally, now we're kind of getting to that regime where we're going to just see more and more volatility if he continues to kind of go down this path of trying to, not provide any forward guidance, not and be more ambiguous, I guess, with what his views or what the views of the central bank, is, or what they think they're going to do in the reaction function. So I think this is kind of setting up for like a new status quo in the markets. I am interested though because I'm looking at the Bitcoin chart. It's at 64.6 right now, up over 1% over a 24-hour period. You're seeing a lot of divergences because you're seeing bonds obviously sell off. We were talking about the 30-year. You're seeing the dollar also sell off despite the rise in yields, and maybe that has to do more with just the front end. But at the same time, you have real yields at the 244, which is I think a cycle high, but you have inflation break evens hovering, diverging lower. So that's kind of telling me that inflation expectations are kind of coming down, but the real cost of capital is going up. Tyler, like what do you make of this? All this divergence between stronger Bitcoin, weaker dollar, rising yields, and do you think that this is a kind of like a breaking point from that real yield choke point that we've typically seen on something like Bitcoin, really?
It's very interesting to watch. I think it's a little bit early to say if this is really the breaking point that you're alluding to. What we've been watching a lot too is really the situation out of Asia and Japan, especially as we've seen the yen pushing 164 here repeatedly the last couple of days, and really the yen being at I think 40, 50-year lows, as well as rising long end of the curve in Japan. And so I think some of the dollar moves probably driven by the yen situation, the yen carry trade. But I would strongly agree with your sentiment on the press conference that even though Warsh is trying to have the Fed take more of a backseat and let the market do the work, I think the lack of forward guidance and the kind of ambiguity that is providing is going to be a heightened source of volatility and of surprises for the market going forward, where it almost makes these FOMC conferences into more of an event than they were previously, just given the market uncertainty and the lack of commentary.
In some ways, that's kind of funny because I think, correct me if I'm wrong, but Kevin Warsh's position has always been that the Fed should kind of take less of the spotlight of people's attentions, right? He wants it to be kind of more in the background, let things kind of play out as they should with market forces. And now we're seeing, because he's taken this approach, that it's just making each Fed meeting more attention grabbing, more heightened with volatility. And one thing I want to follow up with you, Tyler, is what do you think the risk is that this approach that he's going down this road ultimately leads to the Fed losing control of the curve here?
Well, I think that's a fantastic question, and like he alluded to yesterday, he's kind of happy to let the market, the free market, do the work for him, and I guess if you always take the position that's doing the work of it for you, whether bond yields are going down or going up, maybe that is a tenable long-term policy position. But the question in my mind is, what happens when the market isn't doing the work for him, or the yields are moving in the opposite direction for what the committee overall, not just him as chairman, think are appropriate, and what levers in terms of commentary or guidance or pressers is he going to try to use to manipulate the markets outside of having a surprise at these FOMC meetings?
Tomas, Mark, what about you? Are you seeing any risk of that getting kind of out of hand here?
I personally think that like this concept of controlling the yield curve, or they in theory they could do it whenever they want, right? It's like always an option for a central bank because they have the money printer. So it's as if like, you're playing against the house in a casino, and the question is like, does the casino ever want to like take control and beat you? And as long as they have the chip printer, like they can win because they can last the longest. But it does, I think it's almost like a difficult choice where I think you almost, if you look back 10 years ago to where the Fed was much more involved in the yield curve, not just in the short term, but also the long term via asset repurchases and growth of the balance sheet. Just think about the environment that we were living in at the time. It was low economic growth. It was low yields in general. People were having to shift into equities and higher risk assets to generate even like meager returns in excess of the bonds. And it was kind of just like a stagnant economy. And signals, in my opinion, were also like very much um, biased towards this kind of like low growth, low inflation outcome. Now it's kind of the opposite. It's more of a free market environment for credit. You don't have negative real rates. The economy has to like shift capital to where it's most productive. You have higher growth, but you also have higher inflation. And so the question really becomes, in my opinion, like what's the better trade-off? A low growth environment with low yields and perhaps lower volatility, but where the debt to GDP is really high and you can't really grow yourself out of it in that environment, or one where we have more market volatility, but more of a chance of actually growing the economy significantly, where capital is more productive and where maybe you have a chance to defeat this like debt overhang. So I know it's a very roundabout answer, but I actually think that that's kind of the choice that you end up having to make. Is do you want to be like an interventionist where you have this like low volatility but predictably bad path, or do you want to just like kind of sit back and let the market make the calls for you, but it's going to be more volatile. The challenge here is like, what is the job of a central bank if they're telling you the market's going to do the job for them? It's just a very weird, contradictory situation.
Yeah, and I think personally, with the absence of more direct forward guidance, we're already starting to see that impact with increases in volatility around the events, the Fed events. But the thing is that like what you were saying, they do have the the ability to control the yield curve if things get out of hand. But for me, it's like, is there going to be like the willingness to do so? And I think that's where Mr. Market's really trying to really test them, and we're seeing the bond market just basically catching no bids. I think that was like the quickest steepening in some time that we've seen in a daily, and so we're really seeing that kind of accelerate. Mark, what about you? Are you seeing risks of losing control of the long end?
No, I mean, yeah, they do have the tools in their toolbox to get that under control if they want to. I guess what I kind of find funny in all of this is they're removing forward guidance to kind of let the market focus more on the economic data and less on what the Fed's doing. But so far, it's kind of the opposite effect, because now this feels like 2022, where everyone's looking at inflation prints, and then you'll see the Fed funds futures move because they go, okay, well, what's the Fed going to do? So it's almost brought it more into focus than had they just kind of given some type of guidance statement and let it go, because now the market does have to continually reprice for where rates could be, for where inflation could be. So that's kind of my read.
Yeah. No, it's definitely a tricky. I think one thing that I kind of keep going back to is what's the ideal situation for Kevin, for Mr. Warsh. He's new at this job, obviously coming in with a relatively tough situation. And so I've been saying this over and over again, that the ambiguity, the lack of forward guidance is going to be a great tool for him if he's someone who wants to, one, make his position not clear at first that he wants to cut rates because he doesn't want to threaten the independence of the central bank. But two, buy time until the economic data starts to support a view of cutting rates, and we don't have that right now. We continue to kind of get derailed off that path with every re-acceleration of tensions in the Middle East. So I in a tinfoil hat kind of world, I'm kind of thinking he's sometimes trying to just buy time. And honestly, he sounded surprisingly more dovish than I anticipated this meeting. And he certainly kind of brought the hawkish flavors in his first press conference, and this time I think he definitely wanted to kind of dismiss any reporter's suggestion of this is what the committee is starting to think, or just kind of keep everything very murky, if you want to just kind of summarize it that way. So that way, I think we're just gonna have to kind of wait for the economic data to kind of support that. And speaking of, we saw GDP come in this morning a little bit softer than expected. It came in at 1.5%. I think the expectations were around 2. This is something that is a pretty decent miss. But really the drivers were, I think, the reduction in net exports. We see some external demand weakening, but the internal demand of the economy seems to be strong with consumption, and also the AI spending and Capex. So, Tyler, what's your take so far on U.S. growth? What are you seeing from like a U.S. economic outlook perspective on your end? You wear the CIO hat. I know you've got a detailed view of this.
Well, the previous question you asked about like what's the best case scenario for Mr. Kevin here is one we've been thinking about too, and I think what he would love to see to make his job easy is economic growth remain very strong here, and so this GDP print was obviously a miss on that front, and he would love to see the Middle East tensions resolved and oil and energy prices coming back down, where the committee could have a lot of air cover to write off those inflationary pressures as short term or as resolving naturally. And that he would love to see, the tariff pressure fall too. So, falling energy prices and a strong, booming domestic economy, especially with this AI capex and with a strong consumer, would be the best case scenario for him. To flip the question around is like what's the flip side of that scenario that makes his job very difficult? And I think that's some of those factors that you're alluding to right here with GDP miss, and with uncertainty in the Middle East, and with oil prices staying elevated, and also the uncertainty in the AI markets, the hiccups we've seen here in the last couple trading sessions, especially as the market is maybe beginning to de-risk some of that trade, or question some of these capex commitments. Especially as we've seen like the credit default swaps on a number of these hyperscalers blow out in the past couple days. And so all of those data points I mentioned feel like they're moving in the opposite direction for what makes his job easy, even though he's still saying that he'll let the market kind of do the work for him.
Oh yeah, I think obviously like a Goldilocks soft landing with productivity gains is probably a relatively great outcome with the diffusion of all these uncertainties around oil and also tariffs. So, I would agree with that. Tomas, you are the chief economist over at Kraken. I want to get your take here on growth. What did you think of today's print?
I mean, I kind of read it the way you did, which is that on the headline it was a miss, but some of the more like internal factors that ignore net exports and some of the, you know, the challenges with like I had been reading about drawdown in inventories. You had a lot of people, you know, bringing goods in to try to beat some tariff timing, and so I think people are kind of hanging on to those like more narrower metrics of growth to suggest that it was actually perhaps a little bit more robust than the headline would suggest. But it's you know, I think it it still feels like that kind of K-shaped economy that people keep talking about, where you know people are at the median, like struggling with the inflation and finding ways to grow through that, including with the growth in credit and whatnot. But I do think that it, yeah, to your point, it's kind of like a Goldilocks number. You want something that looks a little soft because it lends credibility to the monetary policy not getting tighter without being too soft to suggest like, holy crap, we're going to hit an air pocket. Because one thing with the US that's quite interesting is that despite this very large rise in energy prices over the last several months and the impacts it's had downstream, the US has been very insulated from that impact. We've had a lot of course, domestic growth from AI Capex cycle, but also because we have a stronger connection to domestic resources that we don't feel that impact as badly as in other regions. You know, if you look at European economic growth projections, that's gotten hit on a relative basis much harder, you know, for the outlook for 2026 than the US. So yeah, I took it as a soft headline, but I think people are willing to overlook some of the one-time impacts, look into more narrower reasons to believe that the economy feels robust, but it's not, you know, a simple everything's great story.
No, very good. Mark, I don't know if you want to close this out. I think we could keep going all day about the Fed and the macro picture, but I know we want to jump over to some of the Treasury company reckoning that we're seeing here with MicroStrategy and also what's going on with Bitcoin.
Yeah, no, I largely agree with what Tomas was and you said on the headline versus some of the underlying data. So I think we're good to move into some of those Treasury dynamics.
Yeah, I mean, just to kind of close things out, it's going to be interesting to see. You know, you saw the dissents on the voting with the Fed. It was you had three dissents that were all regional presidents who actually aren't voting members, but you had zero dissents in the actual board of governors. That composition to me was interesting, and I'm also kind of taking note of the Bank of England. I think had also three dissents. We talked about, I guess, volatility and the sequencing of volatility across asset last week with Craig Shapiro, and how when you have volatility start to spike in one asset classes and one asset class, it tends to bleed over to the other asset classes, and there's that chain reaction function. Especially when you get the VIX expiration and all the options expirations you saw last week, which kind of releases the dealer hedging and technical dynamic. I'm interested to see if kind of like we're going to see more dissents across central banks. So it's like you get the volatility dynamic in the markets, and you get the volatility dynamic within the uniformity of monetary policy makers as well. And that's kind of going to be interesting to see how the markets kind of then start to feed off that and that uncertainty, and if it kind of creates this whole kind of perfect storm dynamic as a risk for our audience to kind of follow. But I mean, yeah, let's jump over to the Treasury market update. I just think there's a lot of interesting stuff going on over there too. So MicroStrategy sold 5.43 million Class A shares. I think that extended their runway over 2 years. We're continuing to see them raise more gunpowder, but they are not actually buying more Bitcoin with it. They're kind of just loading up more on cash. And Tomas spoke to that reasoning, I think last week, where there is a stipulation in their policy guidelines where they can't use certain cash ranges for purchases of Bitcoin. So I want to start with Tyler first. If you look at where the mNAVs are currently at, and you're looking at where this issuance is happening relative to the mNAV, you're seeing that you could say that this is dilutive. Do you view what Saylor did this week as a corrective move for the moment, or do you see this being kind of what's your kind of overall take of what happened this week for raising more common equity, I should say?
Yeah, well, I think if you look at the actions this week and really over the past couple weeks, it's pretty clear that Saylor's been playing defense, and I'll almost say the market kind of forced his hand into some of these moves with the price of stretch and the prefs trading down so badly. He's been playing a lot of defense to shore up that balance sheet and kind of rebuild confidence in those products, especially him growing the cash reserve over two years of dividend and interest coverage, which is interesting here, which is kind of best in class. And so, on the equity issuance, I'm sure MSTR common shareholders don't love it, and you can kind of argue based on how you slice the numbers, whether it's slightly dilutive or slightly accretive for the common shareholders. But I think it's a great move overall, and that him still being able to grow the balance sheet overall, even at a really tough time in the Bitcoin market cycle like here, is a really good sign, and that he has materially fortified his position in the market with the addition of all this cash, and kind of dispelling the death spiral scenario that a lot of people were worried about a couple weeks ago, with him being kind of caught in this flywheel of having to raise rates on these products to induce more demand to get back towards his $100 peg. And so I think the defense has been very effective overall. We saw strategy tiptoe into stretch buybacks last week as well, buying back $25 million of those products. And I expect that we'll see more on the buyback side over the next coming weeks. It's kind of a question mark, I think, in the market's mind, what his ideal, how many months, how many years of cash coverage that he's actually going to target. But 2+ years feels very comfortable to him here, and so I would expect that he really tries to use the common equity ATM product to support the credit profile overall, whether it's buying back more prefs, or whether it's setting aside more cash to pay down the first convertible, which is puttable in 2027. And once he does that and continues to rebuild the confidence around stretch and the preferred products, that's when I think he gets aggressive about buying Bitcoin again.
Yeah, I think it's definitely a good move to kind of buy more time. It's something that we've been talking a lot about. I know, Tomas, you've been following MicroStrategy very closely. What do you think of his latest defensive move?
Well, I think one thing to point out is they recently just overhauled their metrics on like how they calculate mNAV, and what their version of it now is actually more aligned with what I've been doing for a number of years now, which is a true net asset value, not like an enterprise value multiple. And the impact of that, which I think is beneficial, is that it more closely aligns this concept of equity NAV accretion with Bitcoin per share accretion, because they're basically creating a tie between the two. Because if you look over the last few weeks, one of the biggest arguments against the dilution is that they were having to make a trade-off between equity accretive dilution versus Bitcoin per share dilutive issuance. And so there was never going to be a win-win situation. So they overhauled those metrics to better align them, which I think is healthy, so that when they take action, it's reinforcing rather than a mixed bag every single time. I if you ask me if I were in their shoes, what I would do differently, I would stop increasing the USD reserve. I would actually issue equity and bolster the cash side to give me optionality to go and buy more convertible debt. Because what I mentioned before, which is per their own policy, USD reserve designated cash should only be going towards interest payments and dividend payments. And I personally think it would be a home run if they started actually taking down more of their liquidity wall that comes up late 2027 into mid 2028 based on these put options, and assuming that the market doesn't recover, by the way. That's obviously a big assumption here. But if they were to do that, I think that would be a much better use of raising cash rather than continuing to add months to an already long runway. That's my personal opinion.
Yeah, we've seen how closed-end funds have kind of run this arc for quite some time, where you have the premiums where you issue, you have the saturation, you get the discounts, and then you kind of force buybacks and wind up, and then you eventually try and convert. Mark, what's your take with the issuance this week? I know you also have been following this reflexivity play for some time.
Yeah, I agree with Tomas on. I don't know if I like that they just took it and stuck it into the USD reserve that they can't use for anything other than the interest payments or the dividend payments. What with their runway, what I would have preferred to have seen is them to actually just raise cash and maybe even have the option to look at acquiring more Bitcoin down the line here. If I just look at Stretch's current level, it's sitting at about 89, so it's not too much of a discount. It wouldn't really need that much of a move in Bitcoin for that to get back up to its peg. So if you're one of these, if you're somebody who's betting against this, what you have to bet now is, will Bitcoin underperform with the discount call it at a 13% rate over the next however many years? And when you get into a 50% drawdown, that's probably pretty likely that you'll be able to beat the hurdle rate. So if any acquisition here could even be accretive long term.
Yeah, I think our fair value model is still showing a pretty good price appreciation if we were to kind of relink ourselves back to money supply growth, which has been strong over the past 6 months. So certainly there's hope for Bitcoin. Tomas, I know that you got to hop here soon, so I didn't know if this is a good time, if you wanted
It
to.
is. I just wanted to add one more comment because I came off as critical with that commentary. I want to do highlight that, when you throw these assets in the USD reserve, it is a policy. It's a self-imposed policy. Policies can change. So if it ever got to a point where a year from now, they got a big debt payment and they got all this money in the USD reserve, it would be a very silly short, in my opinion, to say, oh, like they can't use this money to go buy debt. They can. They just have to change the policy. But my point is that they're already going through a big flux right now around changing guidance, metrics that the market should look to. They just recently introduced this policy, and it has a quite narrow use. And so for me, from my perspective, in an environment where they're more actively managing their cap structure, it behooves them to honor the policies and the guidance that they're presenting right now,
Mhm.
while also giving them the flexibility and the optionality of having free cash to deploy it wherever they want. That's where I'm coming from on this. But I ultimately think that if you are betting against MicroStrategy at this point, to Mark's earlier comment, you're basically placing a long-term short on Bitcoin, which is a very difficult trade.
Yeah, yeah, and I think that policy does inherently lend itself to give you some sort of confidence in in its seriousness of trying to service those dividends, trying to service its debt. And so it kind of plays that effect right now. If you wanted to change that later on, by all means, if you find it to be a good opportunity to start buying Bitcoin again and accumulating, you have the optionality, right? So it's kind of a genius move. And that's where I wanted to ask Tyler, because Tyler, you work for a Bitcoin treasury company. You're the CIO. What do you think are kind of like the key things to look at for a treasury company? You could talk more high level, but to say, okay, these are kind of like attractive times to start reaccumulating. This is the time to start, sticking our neck out and close that runway off a bit. If you were, for example, advising MicroStrategy just for fun's sake.
Well, I strongly agree with you, Thomas, there on kind of the micro strategy guidance, and I think they should be prioritizing flexibility with their cash. This policy about the dividend reserve seems very very reactionary to kind of the sell-off that was induced by them using the USD reserve and drawing it down so significantly to retire the converts earlier. And so this new guidance intended to rebuild confidence and kind of ring fence that cash. But I would do exactly the same thing if I was in Saylor's shoes in terms of raising more cash. But I don't see much of a need to grow that dividend reserve that's earmarked beyond 2 years. I think that's plenty sufficient to build confidence in the product. And so having that optionality to be able to repurchase MSTR common or repurchase prefs or repurchase converts and actively manage the cap structure going forward, and eventually to start buying Bitcoin again would be my priority there. And I think we've got earnings for MSTR, I think, tonight. So maybe we'll get some more updated guidance along that and along these new metrics they introduced, which I'm a big fan of as well. I think do a better job of representing the claims and the value proposition for each position on the cap stack today. Shifting, Gabe, to your question about Bitcoin treasuries, digital asset treasuries more broadly. I think the sector has still been under a tremendous amount of pressure, but I see it in a lot of ways as kind of throwing the baby out with the bathwater. And we've seen some notable unwinds in treasury companies, either selling down their Bitcoin or liquidating and returning capital to shareholders. We've seen a lot of that healthy kind of cleanup and consolidation happen in the market. And there are definitely still some messy companies out there that have convoluted cap structures or unclear governance that probably deserve to be punished with a discount and trade more like a closed-ended trust. But we've also seen this same pressure put on, in what are our opinion as investors, kind of some of the strongest, best positioned Bitcoin holding companies out there. And so, without really giving specific names or guidance, I think there are some very strongly positioned companies that have a big balance sheets, that have huge credibility and name recognition and distribution, that have low debt or low leverage or low burn, in some cases that are even cash flow positive, that are profitable companies by virtue of their operations, that have been equally punished by the market here, and we think excessively so. And so if you can find one of those companies that has a high quality committed management team, that is a clear leader in their sector, whether that's geographical or whether that's kind of the business model that they're running, where they have top of the pool positioning and a strong balance sheet and a vision for the future and the ability to grow, even if it's just incrementally amid a very tough market like here. And you can buy those companies at a discount to their net asset value or their liquidation value. I think it's going to be an attractive time now or over the next few quarters to start building a position and building exposure to those strongly positioned companies that have the ability and the opportunity to really outperform as Bitcoin gets its feet again and as confidence kind of returns to the sector. And especially as the street and investors can do a better job of looking under the hood and understanding the fundamentals and how these companies can differentiate themselves.
Yeah, that makes a lot of sense.
One other thing
Mark.
I've kind of been watching with these DATs too is on the actual token supply side is how much of it do they own and how much of a player they are. If you look at Bitcoin, it's somewhere around 4 or 5% of the supply in these DATs. But if you go down the list, the rankings and market cap, and you look at some other tokens, ETH, you've got now close to 10% in various treasury companies holding. And then another one I've been looking at is Hyperliquid. Treasuries have been accumulating that one like crazy. Now there's more of the Hyperliquid supply. It's like 11, 12% is actually in these treasuries. So they're much larger.
Wow.
Yeah, they're much larger players than some of these smaller coins. With Bitcoin, I'm almost less concerned with there being any sort of structural risk if some of these treasuries were to blow up or have to sell their Bitcoins, because most of that is in MicroStrategy already. That's pretty unlikely to need to unwind that. But yeah, some of these names like ETH, Hyperliquid, with these other treasuries, I'm starting to wonder if there's a little bit of concentration risk there with the underlying tokens, as a few of these key players have such a large chunk of the supply. I'd be curious to get your guys' thoughts on that.
Let Tyler go first. I think this is wheelhouse.
Yeah, I mean, I agree with that sentiment broadly. Our focus is really on the Bitcoin side of things, and I do think MSTR does have an outsized position or outside risk. And we saw the jitters in the market as they did sell some Bitcoin, first the token amount and then a meaningful amount. But the Bitcoin market is so large and so much volume and liquidity that some of these smaller players unwinding or even MSTR selling some Bitcoin is kind of just noise in the long-term signal. I agree that that's not necessarily true of some of these other tokens or DATs, and there should be much more of a overhang there in investors' minds.
You talked a little bit about how it's important to find these quality companies that have either like an operating function to them that can support the accumulation of Bitcoin. And are there any strategies that you're seeing emerging in the debt space for monetizing Bitcoin? I know that there's Bitcoin options. You could either sell puts, write calls, as a way to either accumulate at lower prices or harvest income if from the upside. What are you seeing from your seat?
We are seeing a lot more of that activity in terms of active management of the treasuries or yield strategies kind of across the Bitcoin sector, especially in this environment where everyone is trying to eke out every source of yield and growth in an environment where Bitcoin prices have been down solidly all year long. And so I expect we'll see more of that, and I think we're seeing that kind of volatility harvesting on a pretty widespread scale here in Bitcoin. Even if you look at some of the actively managed now Bitcoin ETFs that are selling volatility and capturing that yield, and so that trade has only gotten more popular. I feel like it's pretty consensus right now, and that's what I would chalk up a lot of the volatility compression that we've seen in Bitcoin overall. And I expect kind of a lower volatility regime in Bitcoin going forward because of that kind of call override activity. But that that volatility suppression can also cut both ways. It dampens volatility until it doesn't, and it also kind of sets the conditions for some of these explosive moves upwards in Bitcoin. And so, from our viewpoint, that Bitcoin volatility spring has been compressing and dampening for quite a while, especially in this market regime. But what will be interesting to watch is, who's offsides or what kind of risk management firms are running. If we see a big rebound in volatility, or we see a expansion there again, especially in a bullish market environment.
What do you think's next for the industry? I think, or for Bitcoin particularly, because just to give a little bit of background from my perspective, we saw how with the institutionalization of regulated futures, that led to basis trading on Bitcoin, which led to a lot of fund inflows from fast money hedge funds that were harvesting that premium, and then we got the approval for options on the ETFs that led to the call overwriting, and that's been a function of compressing volatility systematically for some time. I'd just be curious, what do you think is the next opportunity? What's the next trend for more like tactical fast money investors, more like the active side?
I think, some of those strategies that you mentioned, especially basis, were responsible for a ton of the headline ETF flows we saw over the last year. And so, when you read these headlines about billions of dollars flowing into the ETFs, I would actually discount that quite a bit. I think a lot of that capital was not Bitcoin convicted capital that was trying to express a long-term view around Bitcoin, but was some of that fast money that you mentioned, that was part of a delta neutral strategy ultimately. That's cooled significantly, and we've seen the ETF unwind accordingly, as some of those basis or other hedge trades have gotten unwound here. What I think is really the next frontier, and where we are looking to start to see the capital flowing, is even more exotic versions of that type of trade. And ultimately, as painful as it can be on the way down here, I think the volatility in Bitcoin is part of what makes it so attractive and interesting as an asset. And as we say, it's the price we pay for the excess returns we've seen in Bitcoin here. And so as volatility stabilizes or picks up, we're seeing a lot of interest in kind of structured note products or other bespoke derivatives products, accumulators, decumulators, linked participation notes that now some of the large banks have developed a lot of expertise around, or have built their own products around, that they can sell into their hedge fund clients and into their high net worth investor bases, that leverage Bitcoin as the core asset, and the volatility profile of Bitcoin to produce very interesting financially structured type products. And so, our thesis is that could be a major driver of growth, at least on the spot asset side again, even if that's not all necessarily long Bitcoin capital.
Obviously, I think the market right now is consolidating quite a bit. We're seeing that compression and volatility real time. Bitcoin's trading at 64.4. I'm seeing us really, like, those moving averages really just starting to kind of dance with each other and overlap. We're not really getting any major moves. We haven't gotten a major move since early June. And really, I think, the market's kind of looking for the next catalyst. One of those catalysts is, of course, the regulatory side. So I wanted to kind of close out with that topic. We've been talking about clarity now for, gosh, I think since I've joined CF Benchmarks, and it seems like we've that would be mid 2022 for reference, but it seems like we're finally getting to the 1 yard line, is what we keep seeing on X, and it seems like it's still very elusive though. What's the UTXO view on clarity? Do you guys support the current market structure bill that's been drafted? Have you had a chance to look at it? And when do you think this is going to get passed?
Yeah, so we support clarity. We support the bill as drafted. I think what we care about the most as Bitcoiners is some of the language around developers and open source projects and the financial freedom and sovereignty. And I think this that's been in and out of a few drafts of the bill. I think overall we're pretty happy with the current version. But I'd say my take on clarity overall is very bearish here. I think the chance of us getting it over the finish line before the Senate recess or in the near term is very, very slim. I think that's fortunately priced into the markets, even if the prediction market odds are higher than that. But I think in the Bitcoin sentiment overall, I think the market is essentially pricing it at a zero odds in the near term of going through, which is great. It means there's always the opportunity for a surprise to the upside, but we're pretty bearish just at the rate of progress and where things stand today that it'll actually get done anytime soon. Even though we're still hopeful and optimistic that maybe there's a chance.
This is going to be kind of a silly question to ask following this, but what we do every round as we close out the hour is we go and talk about our week ahead, things that we're watching, and obviously I think clarity is really top of mind. Though it does seem that the bill is not going to make it to the floor for a vote until after the August recess. But I do want to do the tradition and go around and ask both you and Mark. We'll make Mark go first since you're our guest of honor. And Mark, what are you seeing for the weekend? What's top of mind?
Yeah, so top of mind on the economic front is going to be the jobs print on Friday, and then the ISM data on Wednesday, and then industry specific, it's going to be whatever comes out of MicroStrategy earnings tonight. We'll see how they act in the market over the next week, as well as the ETF flows. And then, yeah, on the Clarity Act front, what I would be looking for at this point is to see the White House's reaction to the Democrat version of the proposed ethics provision. Pretty unlikely they vote, but that will kind of tell you where the direction of travel is and maybe what the speed of travel is into the next year.
We're getting a jobs report on Friday? I think it's next week. It should be on the 7th 7th of August. But yeah, we'll get the employment cost index on Friday. So I will be watching the employment cost index. I want to see to make sure that the wage pressures are not picking up, though I don't believe they are. I would say the demand for employment is pretty locked. It's a no fire, no hire type environment right now. I expect that to kind of continue. I am going to be watching, I think, earnings coming out of strategy and seeing what trends. Those are kind of like the situations that we were talking about earlier in the call. Obviously, if there's any upside surprise out of the Clarity Act, I mean, this is like what markets are priced on, right? Tyler was very astute to point out that it's all about expectations, and right now the expectations are 0%, meaning that if you were to see a deviation from that, that's not being priced in right now and the market's going to react. I would agree with that entirely. So let's see. I think there's still a slim chance on Monday or Tuesday next week, maybe very, very slim chance, but maybe they could somehow figure out to put it on the floor for a vote. But other than that, yeah, that's really what I'm focused on. And I'll let Tyler here close us out with what's top of mind on his side.
Those are some great highlights. I think really MSTR earnings after hours today is probably what we're most excited for, and see if with the guidance provided as well as whatever actions they took today or this week, raising cash, running ATM programs, see if they expand their buybacks of stretch at all, and if he can give the market enough confidence to get it back trading in the 90s, which has been the ceiling on it in recent days. So paying close attention to that. And then the other thing I'd mention is, even while we're talking here, we've seen a pretty mega move with the yen jumping below, move from almost 164 below 160 here. So we gotta figure out what intervention is happening out of Japan, what's causing that huge move, but something we're watching closely as well.
Thank you. Yeah, that's stellar stuff. Tyler, it was awesome having you on. Really, really appreciate the insights. You really bring a unique perspective with everything, and it's very timely. So we got to have you back soon, hopefully. And yeah, just thanks again for participating. Thank you to the audience for jumping on. Always do your own research. That's how I finish things up. There's a lot of volatility, a lot of uncertainty in markets right now. Be sure to trade safe. And until next time, be sure to join us. Go to UTXO.com to like and follow all the stuff that's coming out of Tyler's team. Go to CF Benchmarks to follow along with the research and insights that we produce. And looking forward to seeing you all next week. Have a good one. Bye.
Thanks. Take care.
Thanks. See ya.
Cheers.